Hey guys, in this video we will explore how to invest in the recession or bear market. It is often during recessions where there might be the best opportunities in the stock market. It's a great time to invest for those brave enough. How to invest in the recession is potentially the million-dollar question that you would have to ask. So the question is, what is a recession and are we already in one? I've asked this question before in my previous video, when to buy stocks in a recession, the ideal time to pick a bottom. Recession is often characterized by 2 consecutive quarters of negative GDP growth rate. At the point of my video just a couple of weeks ago, I highlighted that the Bloomberg Recession Tracker calculated the odds of a recession over the next 12 months at 53%. In the latest update on 8 April, the probability of a recession happening over the next 12 months is now 100%. So according to Bloomberg, a US recession is imminent. Investing during a recession often yields the best opportunities. The current economic downturn is undoubtedly going to be a painful one for many. Businesses around the world are shuttered, with citizens being issued stay-at-home mandates that could last much longer than most politicians would expect. Many businesses might never recover from this recession. As scary as this recession might be, one should not be expecting the end of the world due to the coronavirus. At some stage, the global economy will recover. The Great Recession of 2008 seemed like the end of the world, for many investors, with the stock cratering more than 50% from peak to trough. Yet it actually presented a strong buying opportunity as stocks subsequently staged a strong recovery over the next decade, which came to be the longest bull market in our history. The 2020 recession can again create great buying opportunities for investors. Quality blue chip stocks or stocks with a high level of recurring revenue typically trades at a premium. The only opportunity to purchase them with any level of margin of safety is during a recession or bear market. The best companies with a strong balance sheet have the highest probability of surviving the recession, potentially even gaining market share when their cash-strapped peers collapse under the weight of their debt burden. Identifying these stocks and investing in them when the prices are beaten down unfairly could see an investor reaping strong returns in the years ahead. So how should you navigate a bear market recession? What is the best course of action for a typical investor who is now facing a bear market recession? Should one actually continue to invest in a bear market? Although I did look to call a market bottom in my previous video, using historical recession data, the truth is that historical performance is never representative of the future. This time round, it could very well be different. What a typical investor might consider doing at this stage is to look at his or her portfolio and determine if a rebalancing might be in order. Ideally, if you're well allocated going into this bear market with a portfolio that is well diversified across stocks, long-term government bonds, real estates, and commodities such as gold as a hedge, you likely have nothing to worry about. However, for most, after an 11-year bull market, most investors are probably stocks heavy. That has got to be very painful in a market like the current one. What is the game plan? Look to rebalance your portfolio. This could mean getting more defensive or getting more aggressive, depending on how you are currently invested. If you entered this bear market with a sizable allocation of long-term bonds, now might be the time to start shifting these bonds into stocks in a strategic manner. Given how low interest rates are, it is right now at 0. I can't see how bonds can actually appreciate much from here on. Use this bear market discount as an opportunity to get more aggressive into stocks. However, if you are heavy in stocks coming into this bear market, then now might be the opportunity for you to take this rebound in the market and sell out some of your weak positions, basically those stocks that will probably not see the light of day. Lighten up your stock position and move them into cash as you wait for the right moment to pounce on the right stock. So start making your list of stocks. I've highlighted earlier that a recession or bear market presents an opportunity to invest in high quality blue chip stocks that have been beaten down. Make a list of stocks that you have always wanted to buy but hesitated due to their premium pricing. Have their prices corrected to an attractive level where value is finally emerging? If so, then start to purchase them strategically. Billionaire investor Howard Marks told CNBC recently in an interview, "I never believed that I know when's the bottom, but I know things have gotten a lot cheaper and it's reasonable to do some buying. If it goes lower, do more buying." In my last video, I used historical recession data to show that the ideal entry to enter this bear market might be when prices have corrected roughly about 50%. However, that's not to say that you should only enter at a 50% drawdown level. Start putting capital to work when you think stocks are at decently cheap level and get more aggressive when the market has corrected near the 50% mark. History shows that by then, the trough is probably near. If you only choose to invest at the 50% drawdown level, then you might risk missing the boat entirely. So, what are the stocks that I'm looking at? I'm not going into details of individual stock counters in this video, but just to highlight the strategy that I'm looking to deploy ahead. Number one, focus on company fundamentals. Growth stocks have taken center stage in the recently ended bull market. If a recession is to occur, many of these stocks cannot grow because organizations are cutting down on their expenses and hence not willing to spend. Many of these growth stocks, particularly those with a weak balance sheet, might well go belly up. There are of course some exceptions which we will talk about later. Find businesses with enduring growth, but in general, the idea is to focus on companies with strong fundamentals, those with good business models that ensure enduring growth even in a recession. Yes, there might be some near-term earnings hiccups, but these companies are in the best position to weather a pandemic crisis like the current one and emerge a much bigger entity from it. For example, we have Walmart, a traditional retailer that has transformed itself and has proven to be an extremely resilient company in the current market downturn due to its strong positioning as the go-to big box store for all your daily necessities. It also helps that Walmart is increasing its e-commerce presence and adding digital capabilities inside its stores. Significant acquisitions and partnerships done over the years now makes Walmart's e-commerce strategy a strong contender against heavyweights like Amazon. Find strong balance sheet and cash generating companies. In times of a crisis like this current one, where revenue might be significantly impacted, a strong balance sheet becomes extremely critical. Companies with inadequate cash or truckload of debt lack the financial flexibility to navigate the economic disruption. While not necessarily requiring a net cash position, companies who are moderately geared, for example, below 0.5 times net debt to equity, might also fall under this category, especially if this is coupled with strong cash generation abilities. Such stocks should generate consistent free cash flow, where additional capital can be used for dividend payments and share buybacks. Ideally, these are blue chip stocks that have a fantastic record of paying dividends consistently, as well as doing share buyback, not from borrowings, but from free cash flow. We have seen how airlines have borrowed substantially in the past to fund share buybacks instead of using free cash flow or save for a rainy day. Now, they are all seeking bailout money. I highlighted this in my video on Warren Buffett selling his airlines and bank stakes a couple of days back. Ultimately, the goal is to identify stocks that have been beaten down alongside the market but whose fundamentals remain robust and thus has the potential to emerge stronger out of the crisis. To do that, it needs to have a strong balance sheet and a good cash generation profile to capitalize on opportunities in this crisis. The second area will be to focus on stocks that are game changers. These stocks are likely falling under the growth categories, as they are definitely not cheap from a valuation standpoint, but their products are radically changing the world. Examples are artificial intelligence, 5G, cloud, big data industries. Stocks from these categories are unlikely to be categorized as value, likely falling under the growth category. While they might seem expensive on a price-earning ratio basis, these stocks also possess the same traits which I highlighted earlier on a company fundamentals, i.e. enduring business model, strong balance sheet, and cash-generating abilities. A key differentiating factor between a potential winner and a loser is that these game changers, while having products or services that are revolutionary and often disruptive, also sport a healthy balance sheet with strong cash generating abilities. Think, for example, Amazon and Microsoft. Some of these smaller companies have yet to generate much earnings, and they might be unloved and sold off during a recession or bear market like this one. However, as long as they have a robust business model which is unlikely to be significantly impaired in this downturn, as well as a strong balance sheet and cash generating abilities to tide them over this period where access to capital might be limited, these are game-changing companies that will not only survive but will emerge out of this crisis as a multi-bagger winner. On the other hand, growth stocks which does not generate much cash could find themselves in serious trouble when funding liquidity dries up alongside their deteriorating top line. So what should we be expecting? Now that the probability of a recession over the next 12 months is certain, what should we expect of the stock market? The stock market entered into a bear market territory in record time back in March, and we are currently witnessing a rebound back into bull market territory again in record time. Unless this recession that we are about to witness is a mild one, characterized by a V-shaped economic recovery, it just does not justify the start of a new bull market, at least for now. It is not unusual to see big positive swings in the bear market. Of the top 10 biggest daily gains in index history, almost all took place during bear markets. It is easy to see why the biggest down days happen during a bear market. Investors panic and start dumping their investments, buyers disappear, consequently, prices drop like a rock and cash becomes king. Sounds familiar already? What happens next? Short sellers have to close up their positions in an illiquid market, thus driving up prices. Investors who felt that they have missed the boat or FOMO, fear of missing out, start piling on, and all of a sudden, we might be back in bull market territory again. So the key takeaway is that volatility is going to be the rule of the day. Our current scenario might seem like blue skies ahead, but I will not be too hasty in concluding that these positive spikes in the market represent that the bottom is already in. So the earnings season is upon us, it's kicking off and it's likely going to be an ugly one. I sense that companies will take this opportunity to kitchen sink, putting the blame on coronavirus for such drastic actions that they are about to take, such as impairments and drastic write-downs of their assets. This will not just be for first quarter 2020, but likely for the entire year, in a bid to start afresh in 2021. Hence, I believe there will likely be huge downward revisions in the market 2020 earnings forecast after this earnings season is done, which could herald a new wave of market selling. Well, some might say that the market might already be looking at 2021 earnings. And with the US Fed being the lender and purchaser of last resort, the only direction that stock markets from here on is up. In conclusion, whether the market is going to hit a new low or whether it's going to be blue skies ahead, there's always a time to invest in this recession or bear market, particularly in solid companies with strong fundamentals and a resilient business model. Personally, I will start to get aggressive when the market drops 50% from its peak. However, before that, I will already be having my list of blue chip stocks ready to pounce on opportunities when they present themselves. With that, we have come to the end of the video. Do smash the like button and subscribe to my channel if you like the content. I will be putting out more interesting stocks and market related videos ahead. With that, this is Royston signing out.